Why we hold losing funds far too long. The endowment effect. Good morning, investors. I want to start today with a simple experiment, one that permanently changed how the world thinks about ownership, value, and decision making. Daniel Kahneman, Nobel Prize winner in economics 2002, and author of one of the most important books ever written on human psychology, Thinking Fast and Slow, co-authored a study at Cornell University that produced a result nobody expected. He randomly gave a group of students a coffee mug. Just like that. No reason, no selection, random. He then asked the students who received the mug, "How much would you sell it for?" And he asked the students who did not receive the mug, "How much would you pay for it?" The sellers wanted $5.25. The buyers offered $2.75. Same mug, same quality, same campus store. The only difference was ownership. And ownership alone made people value that mug almost twice as highly as those who did not own it. Kahneman called this the endowment effect, the tendency to overvalue what we own simply because we own it. Now, what does a coffee mug have to do with your mutual fund portfolio? Everything. What the data is showing right now. As of June 2026, aggregate NAVs of active equity schemes in India are still below their September 2024 peak. Equity funds have been underperforming debt funds on a rolling one-year basis since February 2025, a trend that has now persisted for over 18 months. And yet, redemptions have not spiked. Investors are not exiting in large numbers. They are staying, holding, waiting. Now, some of that patience is genuine wisdom. Long-term investing requires holding through difficult periods. I am not suggesting everyone should exit their funds right now. But some of that holding, and I have seen this in portfolios across the country, is not wisdom. It is the endowment effect in disguise, not a considered, evidence-based decision to stay invested, but an emotional inability to let go of something simply because it already belongs to you. Why it happens? Think about this honestly. When you hold a fund that has been underperforming for 18 months, what is the feeling that stops you from exiting? Is it confidence in the fund's future prospects? Or is it something else? For most investors, it is something else. Selling a fund that has lost value feels like confirming the loss. As long as you hold it, the loss exists only on paper. It is not real yet. The moment you sell, it becomes real, final, undeniable. So we hold. Not because the fund has earned our continued confidence, but because letting go feels like admitting we were wrong. Kahneman spent his career studying exactly this pattern, and his conclusion was clear. The pain of losing something we own is psychologically more powerful than the rational case for letting it go. The fund, of course, does not know you own it. It does not reward your loyalty. It does not care about your feelings about selling it. The one question that breaks the endowment effect. Here is the question I want you to ask yourself honestly about every fund in your portfolio that you have been holding and questioning. Not should I sell this fund, but if this money was sitting in cash in my bank account today and I had to decide where to invest it, would I choose this fund? If the answer is yes, hold with conviction. You have made a considered decision. If the answer is no, the endowment effect is making your decision, not your analysis, not your financial plan, just the psychological weight of ownership. And that is worth an honest conversation with your distributor. The real lesson. Daniel Kahneman proved with a coffee mug what every experienced investor eventually learns the hard way. We overvalue what we own. We hold things longer than the evidence justifies. And we dress that holding up as patience when it is often just attachment. A fund deserves your loyalty only when it continues to earn it. Not because you once chose it. Not because selling feels like losing. But because the evidence today, not the price you paid yesterday, supports continued ownership. My WealthWise pin-up rule for today. Own your funds with conviction, not with attachment. Conviction is based on evidence. Attachment is based on ownership. Only one of them builds wealth. Tell me honestly in the comments, do you have a fund in your portfolio that you have been holding for years? Not because you believe in it, but because letting go feels like giving up? You are not alone. The endowment effect catches every investor at some point. Drop your experience below. This is a safe place for honest conversations about money. I am MV Suresh, founder MV Suresh WealthWise. For regular mutual fund updates, connect with me on Facebook, Instagram, LinkedIn, YouTube and Telegram. Wishing you good financial health. I'll be back tomorrow with a new tip. Till then, stay wealthwise.